Everybody. Happy Friday, last day of July. Wanted to check in with you for our weekly market roundup. There's been a lot going on in the markets today, this week, these last 2 weeks, specifically with earnings, which we've been watching really closely. So we thought it'd be interesting to get Dawn and Jonathan here together to talk about what they've been watching, their thoughts on how things have been going. Many of you probably saw Dawn's LinkedIn post or Mirador's post about our internship program that was a huge hit this summer. We had 4 interns, incredibly bright kids, just out of their freshman year of college, which is shocking to me because I was a hostess at a restaurant my freshman year. One of my favorite takeaways from the presentations, research they presented this week was Katie and Emma's talk on recessions, and they had one bullet point noting that the size of the Fed balance sheet is now over 30% of what the US economy was before COVID. Just to give you an idea of the scale that just money that's been put out in the last couple months. So anyway, with that as a reference point, Dawn, Jonathan, what have you found the most interesting about earnings that have come out this week?
Well, hello everybody, happy Friday. I feel like I'll say a couple things and I want to talk about earnings, but I want to make one other observation real fast, which is so much of this particular quarter is focused on the response to the shelter in place and work from home. And I thought it was interesting. I've been tracking the cars in our parking lot here on Friday. And 4 Fridays ago, there were 4. 3 Fridays ago, there were 12. Last Friday, there were 22. And today there were 44. Whoa. So if we're charting the number, if we're trying to infer something about what's happening just by the cars in our parking lot and trying to make some kind of a connection to what's happening, with companies. And I don't want to drone on about this because I've been talking about it for a while, but it does continue to occur to me. I know, speaking for my own family, in the depths of the with my kids coming home, we bought our requisite extra Apple devices. We had a lot of things that made our home more comfortable that got delivered from Amazon. I continue to grapple with this. Are we at peak, velocity for this momentum? And I think it's very telling that on a Friday where blowout numbers from Apple and a 4-for-1 stock split, this is hearkening back to the 1999 glory days of stock splits, Amazon blowing it out, Facebook blowing it out, those 3 companies representing 12.5% of the entire S&P 500, and the S&P 500's down 0.5% today. So I think it says something about the weight, or maybe the lower half of the economy in the market, maybe not experiencing the full power of this great recovery that, as you pointed out, Lauren, has been greatly aided by the Fed coming to our rescue. So anyway, that gives me more comfort in our cautious elements. And I, as you've seen, and you well know, what we've done over the last month, really, I would say, is simplify the number of holdings that we're holding in Longview and orient them toward things we have very high conviction around over the next 12 months, which we expect will be uncomfortable for very extended periods. So that's all I'm going to say today. But Jonathan, what do you have to say?
Yeah, same. I was pretty surprised when the market is down today. You expect when all of those companies report blowout numbers that the S&P, that the Dow is going to be up 700 points today, or when in fact it's down 200. So that's surprising. And the way I look at the earnings season, I mean, it's essentially over for the market. All of the top players have reported. The rest of the 50-60% of companies have reported. I mean, there's some important ones that'll come later, but it's pretty much over. It was an okay quarter. We had our winners and losers. And I think what the market is saying today, I mean, now the market's turning a little bit, but earlier in the day, you had the broader markets down across the board. You had bonds down across the board. You had commodities down across the board. Other than today, Bitcoin and gold, everything was down. So I think, you know, the next narrative moving on from now is really the fiscal cliff that we have already gone over, actually. So unemployed people did not get their $600 checks this week. They likely will not get it next week. The eviction protections expire today, which means landlords are allowed to give their renters one out of three of which are behind on their July payment, 30-day notices to kick them out. And it seems like Congress is unable to come to any sort of agreement. So that's going to be a big shadow hanging over the market over next week. So
and
scary.
We're marching toward a presidential election here in the next 70 days or whatever it is.
Right.
You know, so that's going to throw in some uncertainty into the mix there too.
Right. And I had sent that chart out the other day where if we look back to 1993, the 75 days prior to every presidential election, the volatility index on the stock market tends to increase on average over 20%. So, you know, over this next 2 months, for sure, things will get a little bit crazy.
Lauren, do you have anything you want to add to that?
Well, I was just kind of despite, or maybe because of all of these things, we've still been finding places to make moves that we have a fairly high conviction in. So Jonathan or Dawn, why do you think there's kind of this disconnect between, I mean, obviously there's a disconnect between the biggest tech stocks and kind of everybody else, but we are still fairly optimistic in finding companies that we think have kind of been neglected or overlooked or mispriced for whatever reasons that we're taking positions in. And I'm sure clients have noticed if they're following trades going on in the strategies. Is there anything else you guys want to say about that?
I'll make a quick point, Jonathan, and then you can add to it or disagree with it. But I thought it was interesting. You think about what the implicit bargain is when you're buying a stock at a particular price, and you hear a lot about this mythical 20% growth, and I think it's smart to just break that down into what does that really mean? What does that really? Why is that so important, and why is it so rare? And if you go back to the sort of one of the core fundamentals of compounding, something called the rule of 72, where you take whatever rate of return you're on a given whatever and divide it into 72, what you solve for is the amount of time it takes to double. So if you're growing at 20% per year and you divide 20% into 72, then if you're measuring revenue, you would be doubling every 3.5 years or 3.6 years, or earnings per share doubling every 3.6 years. So I think it's interesting when you're buying a stock, you're sort of making this implicit deal that the management of that company is going to be growing, taking that capital that you're giving them. They're going to sell widgets or whatever they sell. They're going to make profit. They're going to reinvest that profit and get 20%. And so they're going to keep growing. They're going to grow their sales at 20%. They're going to grow their earnings at 20%, and their stock price is going to double every 3.5 years. That's what's sort of happening. And you look at a company like Apple, it's been happening for a long, long time to get to $1.79 trillion of market cap. And this, I started to refer to this last week with Intel. So the next double would go to 3.6 trillion, and then the next double would go to 7.2 trillion. So you see the challenge of companies when they get that large is, literally we will all have to start eating iPhones in order to, buying $1,300 iPhones and eating them every day and replenish the stock in order to make all that math continue to work, because with 7.5 billion people on the planet, and probably 5 billion of them, it's a little out of their price range. That's so what gets back to when we're looking at companies, and we see something that's $1 billion company market cap wise with 500 million in sales that are growing at a pretty rapid clip, it's easy for us to make a case for owning something like that. Where the other phenomenon that's happened over the last 20 years is research coverage has shrunk. People don't follow a lot of these companies anymore. So for us to be able to sift through and find companies that are in pockets of the market that are growth pockets and they're executing well, we are happy to own those companies. And in fact, we go back to all of these key things we talk about. You know, every investment we make, we always ask the question, will we buy the entire company at this price? And a lot of these companies, heck no, but the ones we add, yeah, we would. We would buy the entire company with their prospects and their management and their roadmap and runway at this price. And so those companies we're comfortable adding and sticking with and adding to, as you see even today. Companies that we will add a little starter position when we like the company and like what the management, like what they're doing, but we don't love the price. And if the price goes down, then we do love the price, and then we'll add more to it. There's some evidence of that today. So I'll stop there. JT, you want to add anything to that?
Yeah, I'll add to that. In some talking about the largest companies first, to sort of counter what you're saying, I think the 20% growth, is that sustainable over the long term? At some point, no. But there is the counter argument that, the world is going through a digital transformation, and data is becoming the most valuable, resource in the world today. So as they collect those data and move across industries, there is a large addressable market for them to go after. But also, we can't ignore, I mean, that's like what you said before about a good company versus a good investment. That might mean that they have a lot of runway and they're a good company, but at this point, they may not be a good investment because there are other forces at play other than just, is a company going to grow or not? There are things like monetary policy. There's things like how the rest of the economy is doing. There's things like, are 50 million people going to have a job after Amazon automates anything? Everything, and who's going to buy those with what money? So there are other forces at play. I think the most important ones today, not so much are the companies doing well, but what price are they at? And given what our monetary system is doing at this moment, and if it will ever change, how that will affect those prices, and it'll probably affect them to the downside a bit. So when I look at those big companies and what we're trying to do with these smaller cap names and less covered names is that I look at the Apples and the Amazons and the Facebooks as sort of like the Titanic. It's the only boat in town. It's the only boat to get across the ocean. So at some point you have to get on it. But the problem with those largest companies is that when things turn south, you won't be able to tell. The company will still be growing, but the other forces in the market will cause the price to come down. So if Apple tomorrow drops 10%, is that a buy the dip opportunity? Or is that the start of a massive price kill in the S&P 500 where everything drops 50%? You don't know because it's such a great company and everybody's in it, and there's going to be so many mixed opinions. What we do know, though, is like you said, with the smaller, less coverage companies, we can look at a company like the one today, Proofpoint, which is one I really like. I mean, it's a $7 billion company. It's not very covered. There's not a lot of liquidity in the name, but the management is great. They just reported a blowout earnings. They're upping their guidance. Their market is growing. They're riding on the Microsoft trend. They're doing well, and the stock price is down. So that's an excellent opportunity to get in, and where the fundamentals of the business still matter. If the business grows, the stock price will grow with it over the next 5 years, whereas that may not be the case with, let's say, an Apple or an Amazon. So.
Yep, fair.
Great, thanks you guys.
Awesome. Anything else? Parting words?
Nope, not for me.
I just hope Congress gets their act together over this next couple of weeks.
Yes, we all are rooting for Congress to do great stuff, and then the future president and the future presidents past them are going to have their work cut out for them. We've got quite a little hole here, but we will get through it. We will get through it. So anyway, on that happy note, Thanks again to our interns. Thank you, Lauren, for bringing that up. They had a great summer and we had a lot of fun. Made it feel, some semblance of normal around here to have bright kids bubbling with energy, researching new things and they finished with their presentations. Was it Wednesday?
Wednesday.
Yeah, and so pitched to the whole committee, and so we got a chance to hear the culmination of the last bit of their work, which was awesome. So anyway, on that note, I enjoyed talking with you guys. Obviously, we've gone from 1 to 2 to now 3. So this is good. This Zoom recording, I think, gives us an opportunity to pass the ball around a little more. We continue to get great feedback from all of you on the videos, so we're going to keep doing them. And the great thing is, if this is not of interest to you, it doesn't take long to shut it off and get on with your day. So thanks to you too. Have a great weekend, and we will see you Monday.